Do you believe the Federal Reserve is an independent body? What do you think about the independence?
Oh, it should be, but I think they should listen to smart people like me. I think I have a better instinct than him. If you look, all the economists got it wrong. I got it right along with one other people out of 100. So they should listen to people that are smart. Nothing wrong with that. But they have to make their own choice. But they should listen.
The Federal Reserve in the hot seat today starts its much anticipated meeting. Investors are pricing in a 25 basis point cut, and President Trump is making sure that Americans know exactly what is at stake. Welcome to the Big Money Show, everyone. I'm Jackie DeAngelis, along with my co-host Steve Forbes, Lydia Hu, Brian Brenberg, and with us for the hour, entrepreneur and host of The Fixer on Fox Business, Marcus Lemonis. Great to have you with us today. So the Senate confirming Stephen Miron to the Federal Reserve Board of Governors just in time to vote in this week's critical meeting. For the first time in 9 months, the Fed is expected to cut interest rates, but the president says it's already too late. That's where the nickname comes from. The cut must be bigger, faster, and stronger than Jerome Powell had in mind. At the same time, the courts have temporarily blocked Trump from removing Fed Governor Lisa Cook. That fight is headed to appeal. So the Fed is about to change, and it could dramatically change under President Trump's watch, and we'll be watching for that. But right now, we're watching today and tomorrow, Marcus. We're expecting this decision to come through, 25 basis point cut. But now you've got Stephen Miron having some influence there. Your thoughts on how this is going to go? Some market participants thought, because he was, in fact, too late, that he should go deeper with a 50 basis point cut.
I worry about what a 50 sends to the overall market in terms of what do they know that we don't know. This process of stair-stepping things in feels right to me. What I really like is what the 10-year is doing today, sitting at 4.03. I haven't seen it lately. If we can get it with the 3 in front of it, I think you'll see things start to open up.
Okay, that's a great point. And we do watch the 10-year very closely. That means that this is a market that is confident in everything that's going on. It feels good about the American story, economics of it, Trump's plans, how the Fed is incorporated into that, Brian. There we are, 4.03.
Yeah.
Your thoughts on all the changes, because, the story changes every single day. There's the Lisa Cook element to it, too. She's going to try to go in there and sort of foil things.
Do you think she's going to foil things today?
She's going to try.
Do you think so? That's interesting.
So.
You don't think so? I think she's going to vote for a quarter-point cut today.
She's playing game theory at its finest. She'll be advocating for a cut.
Okay.
Yeah, I think she's going to be in the quarter-point train. There is drama there because she's going to be seated, right? And the court said you can't fire her for the cause thing. That's going to play out legally. I'm interested in that, but she doesn't really matter today. I think she's going to vote for the cut. Markets do not care about the independence question. They absolutely do not care about that question. Nothing the president has done has rattled them to say, oh, this is a guy who wants to undermine Fed independence, which I think is fascinating because every financial press article on the Fed in the last many weeks has said this president seems willing to challenge Fed independence. Nobody believes it.
Rhetoric, not action.
Nobody cares about it. So this meeting, will a half-point cut send a bad signal? I don't know if it would rattle markets. I hear what you're saying. I don't know that a half-point cut would rattle markets. I think it would actually surprise markets to the upside. I don't think we're going to get it. We're going to get a quarter point, and then we're going to watch Jay Powell's guidance. And that's where you could get some play here. If he signals, look, 2 more cuts maybe this year, if that's on the table, I think markets are happy about that. If he wants to play Mr. Hawkish guy still, markets aren't going to like that. That's the big question for me.
So what Brian is saying is that the markets don't care about this question of Fed independence. But Trump, Lydia, is kind of saying that, too. He's sort of saying, I'm just putting my thoughts out there. I'm just telling them what I think. And if they're smart people like he is with his cabinet, he sits, he listens, he processes, he thinks, he adds his own 2 cents into it. So he's just saying, I'm just kind of commenting here, but I'm a smart guy. You should listen.
Absolutely. And I think more conversation, more inputs. What's the harm here? I think a lot of people would agree with that. And I think President Trump made those remarks on his way, when he was leaving the White House just this morning. One thing that I was thinking a lot about is that the Federal Reserve is also a party to this action involving Lisa Cook. She sued the Federal Reserve also as a defendant in all of this, along with President Trump. And it's been so fascinating to see what the Federal Reserve has taken as its position in response, which is basically throwing its hands up saying, we're not going to take sides here. You guys just figure this out and do so ASAP. But when I was thinking about what they could be doing, couldn't they also have kind of turned to Lisa Cook and said, hey, there's some really serious allegations being made about you. We're going to ask you to just sit on the sidelines, not resign, but we're just going to ask to bench you right now and see how this plays out.
Like a suspension.
Wouldn't that be more impartial than what they're doing right now, which is essentially just kind of like throwing their hands in the air and letting her continue to play ball, even though the president says, I fired her? And that kind of goes to the allegations that maybe the Fed really is politicized. That's what I've been thinking about.
Well, yeah, you don't always have to wash your hands of an argument. Sometimes you can weigh in on it. I think is the point that you're making. Steve, this market has just had a lot of steam. Obviously, we're seeing a little red today, but when you keep hitting new records, sometimes there's a little profit taking. So I don't see that as a big move. And I'm just thinking to myself, once we get through this cut, whatever the cut may be, what's the next step for this? We are melting up, and we are melting up big right now. Can that last?
The answer is no. The old saying goes, trees don't grow to the sky, even though this market seems to want to challenge that. And in terms of the Fed itself, only if they did 50 or 75 basis points would the market react. The market's already put in 25 basis points. And the real interesting thing today is not Lisa Cook. The Fed is not going to suspend her. They're going to shove that in Donald Trump's face as much as they can. And the key thing is what's Stephen Myron going to be doing now that he's sitting on the Fed? He's a weak dollar guy. I don't like that. And so what comments he makes is going to be very interesting. And where the Fed's going to go from here, they'll probably do 25 more. But the key thing is the Fed is ignoring, or certainly doesn't know what to do about, the weakening of the dollar. The dollar is going down in the exchange markets. The gold price has doubled in the last couple of years, which is a bad sign for future monetary inflation. Unfortunately, the Fed believes that prosperity causes inflation, not a weak dollar. So they're watching the dollar weaken. That spells big trouble next year.
So you've always said that their mandate, sorry, Brian, part of it should be to focus on the strength of the dollar.
Well, the mandate, they have this crazy mandate passed by Congress, of course. Price stability, full employment, sensible interest rates, but they can make the case. If you don't have a stable dollar, you're not going to get full unemployment, you're not going to get a good level of interest rates, and you're certainly not going to have stable prices. We saw that in the early 2000s when the Bush administration thought a gradual weakening of the dollar would improve the trade balance. We're hearing that kind of talk again from the White House.
I was going to ask you, what would their argument be for letting the dollar weaken a little bit?
The idea, which is bogus, but the idea is, gee, if we let the dollar weaken, that'll make imports more expensive, and therefore they get bought less, and exports cheaper. That'll improve exports and improve the trade balance. What they overlook is once you cheapen your currency, has repercussions far beyond trade. That led up to the crisis of 2007 to 2009. In the early 70s, we tried that, and we saw where that led. So I hope they don't fall in that trap again of a weak dollar. That's what I'm looking at more than interest rates. The other thing they'll look at today or tomorrow is how much are they going to lower the interest rates they pay on bank reserves?
Yeah, you've been on that. You've been on that.
4.4%, which hurts small businesses. They should cut that by 100 basis points, but they won't.
Are they even going to? I mean, what are they even saying about that, Steve? Because you've mentioned that multiple times.
Well, they have another crazy theory that they want excess reserves for the banks, which is preposterous. All it does is muck up the credit markets. We want the banks to sensibly lend, not just park money at the Federal Reserve. Because when they park money at the Federal Reserve at these high interest rates, who ends up getting less? Small businesses.
See, he just keeps bringing me back to this point, Jackie, that the Fed is way too involved in the U.S. economy. They are dominating our economy in ways they should not by sucking out bank reserves, interest rates that are wrong, all the regulatory mess that they've gotten us into the past few years. We have to talk about the Fed. The president talks about the Fed, but the best thing that could happen to the Fed is their mandate would get narrowed massively, in my view, to one thing, which is price stability, and that's it. End of conversation.
Which you get through a stable dollar. Focus on that and forget the rest.
But that's the outcome of stable. That's the outcome of fighting inflation. To me,
the way you get stable prices relatively is having a stable value for the dollar. You know, when you buy a pound of cheese, you get 16 ounces. That doesn't float.
That doesn't change.
And so you want fixed weights and measures. Same is true of a.
So Brian, where do you want the policy to move to?
Well, I think you could cut interest rates right now based on the inflation.
I got the monetary policy, but you said all the tertiary stuff you wanted taken away.
I want all of the well, and they're thankfully they're doing some of this, but all the DEI regulation, all the climate nonsense,
agree with all that. Paying
attention to all of that. All of that should be gone. On the bank reserves, I don't understand why they're talking. You mentioned they want excess reserve. I mean, it's that distorts the economy.
It's forced liquidity in your mind.
The problem is Congress keeps adding jobs to the Fed because our fiscal mess is so big, and they want these guys to come in and sweep it up at the end of the day with lower rates or higher rates or whatever. The government's got to do its job on the fiscal side, and the Fed should see its job shrink on the monetary side. We're backward from that, which is why now we're talking about inflation, no surprise, more than we have in a very long time.
The Fed should not be the bond buyer of last resort or first resort in terms of the government
First resort now.
Yeah.
Marcus, you counsel a lot of small businesses. That's basically what you do on the program, The Fixer.
Yeah.
So talk to me a little bit about what Steve mentioned, small businesses in this environment and what they need to be able to thrive and how the Fed is balancing that.
I think Steve nailed it. It's not just the cost of funds, it's the ability to access the funds. And so the cost is one thing, but you also have credit tightening around what kind of things a small business needs to have in order to secure some funds. You have banks now asking, what collateral do you have? Are you going to put your house up? What other assets do you have? These small business folks that are on Main Street trying to build the dream for their family and build the dream for their town are saying, like, that's why I'm looking for a loan. I don't have any other assets. If I did, I would get a mortgage. I would do other things. The point around what we're giving these small businesses is partially also a focus on what do we want, who do we want the winners and losers to be? And if we want the losers to be small businesses, we keep the policy at the banks the same. That's my concern. Small businesses can't borrow money today.
Should the Fed be picking winners and losers?
They are.
They are, but should they be?
To Brian's point?
The answer plainly is not. And by the way, even before COVID, one of the biggest creators of new businesses were Latinos, were Hispanics. 3 times more than any other group in the U.S. And their biggest problem was bank credit, trying to get loans from the banks. So this has social implications as well.
It sure
has
does.
employment implications, too.
Yes.